This session talks about a fundamental review of the trading book. In short, the fundamental review of the trading book is also called as FRTB, right? Where probably in this slides later I would be using the word FRTB. So just be aware of this short form. Basically, this review is all about the Basel Committee coming up with different kinds of revisions, different revisions to the way the capital is calculated for the trading book. Right, those instruments which are there as a part of the trading book for which the market risk is subjected, right, which are subjected to market risk. How can the bank compute its capital requirement associated with the market risk? So there are quite a few changes that have been suggested as a part of the FRTB, and that is what we are going to look at. So as a part of this agenda, we are trying to look at what are the different kinds of changes FRTB has proposed to the market risk capital calculation. We already know right from Basel 1, Basel 2, Basel 2.5, there are different calculations associated with the market risk capital. So we talk about the usage of VAR, right, 10-day VAR and 99% confidence interval, and then the 2.5 Basel 2.5 has come out with a stressed VAR, where we instead of taking only the recent data, we take 250 days data over the last 4 years, and that to the stressed period. So that is what was the kind of a path that we have seen earlier with respect to market risk capital calculation. So now what we are going to look at is what is it that is being proposed by FRTB as changes to the market risk capital calculation. Then a few important points which are more related to the same concept. So we look at the other important points that are included as a part of the FRTB. Then what did FRTB typically propose with respect to which instrument, which transaction need to go as a part of the trading book and which one needs to go as a part of the banking book. And we all know that these two are entirely different when it comes to the mechanism of the capital calculation. The trading book typically looks at the market risk part. The capital is calculated based on the market risk, whereas the banking book typically looks at computing the capital based on the credit risk. So these two are different. So what did the FRTB come out with? How this regulatory arbitrage scenario can be handled? And apart from this above, what are the other proposed modifications that FRTB is going to come out with? As a part of this, we are going to look at how the FRTB wants to handle the credit spread risk as well as jump to default kind of a risk. How does FRTB propose these kind of risks to be handled in terms of the capital calculation process? Now, getting into the market risk capital calculation, a quick reiteration of the process in Basel 1, right? The way the market risk capital is computed, it's based on value at risk. 10-day horizon, 99% confidence level. We all know the process. And the calculations, typically when I am talking about this calculation, the market variables, whether it is the interest rates or the stock prices or commodity prices or exchange rate, whatever it is. So whatever are the market variables that I am considering, the calculations were purely based on the behavior of the market variables during the recent period, which means the VAR calculation is primarily correct. Very recent changes in the values of the market variables are typical last 1 year's data, last 30 days data. So the recent data is typically being used for the computation of VAR as per Basel 1. Now that is what has been modified by Basel 2.5. We all know that there is a stressed VAR that they have brought in, right? Apart from the regular VAR that was computed based on the recent data, they also suggested a kind of a stressed VAR measure where the calculation is based on a 250-day period of stressed market condition, means banks have to really identify that particular period which was the worst of the possible last 4 years, and that 250-day period should be taken as an input for the computation of the stressed VAR. And it suggested that both the regular VAR and the stressed VAR need to be combined for computation of the market risk capital. This is where the FRTB has actually come out with a few changes. Now the first change that we are going to discuss is, now it's no more the 99% VAR. They don't want the 99% VAR now. They are proposing a 97.5% confidence level expected shortfall. Right, the ES at 97.5% confidence level. This is what they have tried to propose. So basically when I am talking of ES at 97.5% confidence level, I have to look at this tail, right? This is what is 97.5, which is the 2.5% area. So I'll try to find out the VAR at different points and try to take the weighted average of the VAR, and finally take the average, the weighted average, which is what I am calling as ES. Now the expected shortfall at 97.5 typically works out to mean plus 2.338 times sigma. Right, when I am trying to find out each of these individual VARs and trying to multiply with the corresponding weightage, it is seen that it would work out to 2.338 times sigma in case the data is following a normal distribution. And we know 99% VAR is mean plus 2.326 times sigma. So more or less these two numbers are looking more or less the similar. So as long as the data is following a normal distribution, as long as the returns are following a normal distribution, I don't see whether going with 99% VAR or going with 97.5% expected shortfall, there may not be any kind of a big difference with respect to the capital charge. They are almost equivalent. But in case the distribution is having a heavy tail, what we generally find is the 97.5% expected shortfall will have a much bigger value compared to a 99% one. So this is where a conservative approach is typically coming built in, and majority of our return distributions are nowhere closer to normal distributions. They have that level of skewness which can very well address the additional capital requirement that is trying to come out using the 97.5% confidence level expected shortfall. So this is one change the FRTB is proposing instead of 99% VAR. And the capital is calculated purely on the expected shortfall using 12 months stress period. Now it's no more like initially you compute the VAR and then you also compute the stressed VAR and you add up. That is what was there as a part of the Basel 2.5. But now the capital calculation is purely based on the expected shortfall and the 12 month stressed period. So there is a kind of an alteration they are proposing from the 2.5 itself, where I would compute the amount total charge as the current VAR plus the stressed VAR. So that's one more change that they have proposed. But the more interesting part and slightly difficult part is, we know that the earlier model talked about a 10-day time horizon in case of Basel 1 and 2.5. So in general, there was nothing that is varying as per the liquidity. So earlier the model is like 1 day VAR and multiply it by square root of 10. But now the FRTB has come out with a process that whatever the capital that you are computing, it has to reflect that the market variables underlying the transactions will vary according to the liquidity. So the kind of volatility in terms of high liquidity period is completely different from the volatility in terms of the low liquidity period. So what it proposed is, the VAR will change, or even the variable will change. The volatility of the variable will be in accordance with the liquidity. And what it says is, yes, your model has to take into consideration that particular aspect of liquidity also while computing the capital charge. So the way it has initially proposed, so this is like an initial solution, but unfortunately this was rejected for a better solution. We'll talk about the better solution also, but initially it said that each of the market variables, when I'm saying market variables, they could be interest rates or exchange rates or stock prices or commodity prices, whatever it is. So the changes to the market variables to be the changes that would take place in stressed market conditions. So whatever the kind of shock that you are going to give to each of the market variables, it has to be based on the kind of variation that can come out that would reflect the liquidities. So they have broken down the liquidity horizons into 5 buckets: a 10 days, a 20 day, 60 day, 120 day and 250. A simple way to understand is, first, now when I am doing a historical simulation process, I'll take the shock that I am giving is, I look at the price on day 0 and day 10. Whatever is the change between day 0 and day 10, I would be giving that kind of a shock. If I am considering a large cap, let's say for a large cap stock, it says that the time horizon should be 10 days, and probably for a non-investment grade corporate bond, probably it should be 120 days. So basically what it has done is, different kinds of instruments based on their liquidity, it says that the stressing period has to be based on these days. So which means, if I am considering the model for a large cap stock, I would look at a shock which is the change between day 0 and day 10 price. Whereas when I am considering for a credit spread associated with a non-investment grade bond, I would look at day 0 to day 120 as the change. So that is my first trial. In the second trial, I will make it between day 1 and day 11. Then I would be taking day 2 and day 12, and probably day 239 and day 249, something like this. And so that is what I would be looking at simulation part. And of course, once I have simulated the data, the expected shortfall is typically computed as average of the losses in the 2.5 tail of the distribution, because I have generated 250 tails and I am looking at 2.5 percentage of that, because I am looking at 97.5% confidence interval ES to be computed. So this was the method that they have produced, but of course it was rejected at that point in 2014, and a slightly improvised approach has typically come out. So this approach is as simple as, look at the different instruments, break them up into categories based on its liquidity, a 10-day horizon, a 20-day horizon, a 60-day, a 120 and a 250. Then depending on that kind of a horizon, take the change in the prices associated with that interval of time and that give that as a shock. And that particular shock, based on that particular shock, compute your expected shortfall. So there was an improvisation because the model was rejected. What it says is, no, don't compute it separately as 10, 20, 60, 120 and 250. Right? All the calculations should be based on the changes in the market variables over the 10-day overlapping period only. Yes, go ahead with categorizing the instrument. 1, 2, 3, 4, 5. Category 1, category 2, 3, 4, 5. All the market variables changes over the 10 days, 20 days, 60 days, 120 days, 250 days. So first compute the ES when the 10-day changes are done to all the variables. First change all the variables by 10 days. Based on that compute your ES. Let's call it ES1. Then again calculate one more ES. Apply 10-day changes to all variables in category 2. Whichever are the instruments that are there as a part of the category 2, make a 10-day change to all the variables in category 2. But keep the category 1 as constant. So keep these variables as constant. Make changes only to these and all these 4. And then after that keep these 2 constant and then again compute an ES where a 10-day change is being made to all these variables. Right? But of course here you require a 40-day change. So the way you can do is you make a 10-day change and multiply it by square root of 4. Right? The ES is calculated for 40-day change is twice the ES calculated from the 10-day change. So first compute the 10-day change and assume that 10-day periods are more or less uniform. Multiply it with the square root of 4. And after that keep these 3 as constant and make the changes to the variables of these 2 and based on that compute the ES. Again make a 10-day change. But of course here we require for 60 days. So which means you multiply the 10-day ES by square root of 6. And the same logic goes till the last. So which means you are computing 5 ESs. ES1 to ES5 is what you are calculating. And the way you compute is like this. So for each one, ES1, fair enough. So you will get a ES1 squared. The way finally you are computing the ES is ES1 squared. Now look at each one. Let's assume J equal to 2. The way you are getting it is ES2 times LHJ. LHJ is 20. The time period that is associated with J is 20 days. And the previous one is 10 days. So times this and you are doing a squaring. So basically it is coming out as ES2 square. Similarly, if I have to do a ES3, this becomes 60, this becomes 20. So square root of 4. Right? This becomes square root of 4. So it becomes ES3 times square root of 4 and that entire thing is squared. So it is basically a ES2 times ES3 and this entire thing is squared. So like this it keeps continuing, right? So this is the way you compute the overall ES by computing 5 separate ESs and after that you are trying to integrate all those 5 using this kind of an expression. So we are trying to find out 5 different historical simulations involving 10-day changes in the variables. So that is what is the kind of a proposed structure which FRTB has come out with for the computation of the market risk, which involves the computation of the expected shortfall with a 97.5% confidence level. Apart from this, a few more interesting points that have been brought out by FRTB, looking at the practical side. Now, yes, I have to get the 250 days of trusted data for all variables. That is what is the kind of a basis for me to compute the capital charge. Now, it's a real practical scenario that it is very difficult to get all the stressed periods using all the variables. Historical data may or may not be available of the past. Now, this is where the FRTB has given a kind of a flexibility. Yes, if you have taken 20 market variables to identify the stressed period, probably interest rates, exchange rates, all taken together. If you have taken 20 different market variables, then at least make sure that you have 75% of them, which means 15 of them. And you do the stressed period calculation. You take the stressed period, you compute the stressed period based on these 15 variables, which is a subset of 20. So based on this, you compute the ES, right? Based on this, you compute the ES. Now what you do is, whatever the ES that you have got, let me call it ES1, scale it up. The way you scale it up is, compute the ES based on the recent last 1 year data, 12 months data, using all the 20 variables. So at least the recent data you should be having, only the historical data you may not be having, but the recent data of all the market variables we definitely have. So what you do is, first identify a subset of variables. Let's say 15 out of 20, 75%. So using that 15 variables, identify your stressed period, and based on that you compute the ES. And after that, the next step is you compute the ES based on the recent data, recent 250 days data, and taking into consideration all the market variables. And then consider the recent 12 months with only the 15 variable. Whatever is the ES difference that is coming out, the ES initially considering the recent data and 20 variables versus the ES computation using the recent data and 15 variables. So in case the data is not available for the historical period, this is a kind of a mechanism that the bank can typically follow in terms of computing the capital charge. So that's one kind of a flexibility they have in terms of the non-availability of the historical data for some variables. But of course, the minimum subset should be at least 75%. Then the different market variables are divided into different risk categories. We know that. We have been talking about market variables are associated with interest rates, with equities, with foreign exchange, commodity, credit, all the other stuff. So we know that while computing the expected shortfall, the overall shortfall has to be, expected shortfall for the entire portfolio has to be computed. But what the FRTB is also proposing is not only for all, even for its each individual risk category. Okay, for interest rate risk, what is the kind of ES? For equity risk, what is the kind of ES? Like that. For different kinds of risk categories, what are the different expected shortfall? So basically, you are trying to compute the expected shortfall for the overall portfolio, which will include the diversification benefits between the risk categories, and along with that, individually for each risk category I have to compute the expected shortfall. So the basic understanding is the expected shortfall of the overall portfolio will be lesser than the sum of the expected shortfalls for each of the individual risk categories because of the diversification benefit that can come out between the risk categories. And the way you compute the expected shortfall for each category is take all the variables in that category. So when I am talking of interest rate risk category, take all the variables that are determining the interest rate risk and keep all the other variables, the equity prices, keep them fixed. So don't make that a short-term interest rate change can impact the equity prices as well. Don't take that kind of a difference, that kind of changes in the other risk categories because of the change in the variables in a particular risk category. So that is the way you compute the expected shortfall. We are shocking the variables only in a particular risk category, and all the other risk categories we are trying to keep them fixed. And obviously we know that the overall portfolio's expected shortfall should be lesser than the sum of the individual expected shortfalls that we are computing. And the capital charge right now will be computed based on two parts. One is the ES of the entire portfolio, and the second is the sum of the expected shortfalls of each of the risk categories. And these two are joined with some kind of weightages, and these weightages are typically designed by Basel. So that's the way the overall marketing risk capital charge is computed based on the FRTB proposals. And the other important aspect that they have suggested in this context is the backtesting should be done based on the VAR itself. Take the last 250 days or 12 months of data and try to find out how many exceptions are typically coming up. And here you are using both 99% as well as the 97.5% confidence interval stuff. Now, all these things, whatever I have discussed till now, where the ES is typically computed based on the internal model approach. Every bank will have its own internally designed model, its own categorization of the various variables into the various risk categories. So there is a lot of internal model in place. But in case a bank does not have any kind of an internal model, or in case the internal model is created but is not yet approved for usage, until that period, Basel suggested that the banks can use a standardized approach. And this approach is straightforward. Identify all your instruments and categorize them, group them into risk categories. So different risk categories, all instruments, you group them into different risk categories and come out with a standardized risk measure for each of those buckets. And so this is the kind of a formula that you can use. So basically the weights, individual standard deviations or the measures, and the kind of correlation that exists between them. So basically it's more similar to your variance covariance kind of an approach. So but like this, you combine or compute the standardized risk measure for each bucket. You combine all of them with some kind of a weightage to determine the overall regulatory capital. So this is a kind of a standardization approach that the banks can follow in case their internal model is not in place. But what is typically understood is if the bank has a typical internal model, they can very well reduce their capital by some percentage of the capital requirement that comes out using this standardization approach. Now, the next important aspect as a part of this FRTB's proposal is some of the positions, how they are dealt with respect to trading book and a banking book. First of all, the basics are clear. Trading book, any instrument that goes into the trading book, if the bank has some kind of intention to trade, so buy, sell and may not hold until maturity. right? It will not hold it until maturity. It should be able to buy or sell depending on the price fluctuations. Whereas something that is held in the banking book, it is held until maturity. So generally all the loans of the banks, they go under the banking book, and anything to do with the trading purpose, it goes into the trading book. And few interesting important aspects associated with these two is something that's a part of the trading book is mark to market on a daily basis. The revaluation is done on a daily basis, and the capital requirement associated with the trading book is based on the market risk capital. Whereas in case of banking book, it's not mark to market, and the credit risk is what comes into picture, not the market risk. So the capital computation is based on the assessment of the credit risk and not the market risk. So that is where the difference in the way the capital is computed exists between the trading book and the banking book. In some cases, the capital is calculated based on the market risk, whereas in case of a banking book, it is calculated based on the credit risk. Because of the different ways in which the capital is calculated, there is a possibility of a regulatory arbitrage, which the banks have typically exploited. Some of the transactions which were there as a part of the banking book, they tried to reclassify them as a part of the trading book, because the capital requirement in case of a trading book is lesser compared to that of a banking book. That is what I am calling as a regulatory arbitrage. So anything that is a credit dependent instrument like CDOs, or for that matter any other instrument that have the underlying credit, the CDS, credit default swaps, which have the underlying credit instrument, they are all categorized under the trading book by the banks because they are subjected to less regulatory capital requirement. That is what they have exploited. And of course, it was addressed in Basel 2.5, where the incremental risk charge IRC was introduced. We have talked about it in our Basel 2.5 session earlier. Right? Now, the way it works is, what FRTB has done is, now forget about all this stuff. Classifying an instrument, classifying a transaction, whether it goes into the banking book or a trading book, it has come out with a few set of rules. It's not that just the bank has an intention to trade. Earlier, something is classified into the trading book if it is found that the bank has an intention to trade on it and not hold until the maturity. But now the modified stuff is saying, no, it's just not the intention to trade. It should be able to trade and manage all the underlying risks associated with that instrument on a trading desk. So all the risks that are associated with that particular instrument, they have to be managed properly. And whatever are the day-to-day changes in the value of that particular instruments, they should affect the equity. They should either increase the equity or decrease the equity, which means there should be a kind of a threat to the solvency. If the equity value reduces, the debt to equity ratio increases, which will have an impact on the solvency of the bank. So only then all these instruments are getting categorized as a part of the trading book. And it has come out with more and more objective rules for each of the instrument, whether it should be categorized as a trading book or a banking book. And more importantly, the instruments are assigned when they are initiated. So when a particular instrument has started its existence, that is when it will be classified either into a banking book or a trading book. And after that, if we want to change from one book to the other, it's very, very stringent in terms of the rules. Only in extraordinary circumstances this change is possible, and that too, any kind of a capital benefit, any kind of a capital gain that is going to come because of this move from trading book to capital book or vice versa, that is completely disallowed. So it has no impact on realization of the capital benefits because of the change from one book to the other. And a few other modifications that have been proposed by FRTB, right, especially for those instruments which are dependent on the credit risk like the CDSs or CDOs, etc. So it says for these kind of instruments, look at the credit spread risk separately and jump to default risk separately, right? The credit spread is basically the spread between the returns of the instrument and the risk-free rate of return. So this is what is the credit spread, and the risk that this spread will change. The spread can either increase or decrease, and because of this, the mark-to-market value of the instrument is changing because the discounting factor is changing. So the mark-to-market value of the instrument is changing. So here there is no default, actually only the credit spread has occurred. So this would be handled more or less similar to other market risks also, other kinds of market risks. Whereas when it comes to jump to default risk, it is more to do with the default by the company, where an immediate loss. In case of this aspect, there is no immediate loss. Only the mark-to-market value of that instrument is falling down. Whereas when there is a kind of a default, there is an immediate loss or gain to the bank. And this one is typically handled separately. So these two are separated now. And associated with the jump to default, we are talking about an incremental default risk, which is called IDR. Based on the VAR calculation, 1 year time horizon, 99% confidence, 99.9% confidence level. So this is what was used even for the credit VAR calculation earlier. So it is applied to all the instruments that are subjected to default risk, even if the equities are associated with the default, even that portion is applicable to the equities as well. But if you try to remember, associated with the liquidity, earlier in 2.5 we were talking about usage of constant level of risk calculation, but this time the FRTB has proposed that we should not go ahead with the constant level of risk calculation. When I am saying constant level, earlier if you remember, the banks were estimating the liquidity horizon for each credit dependent instrument. So let's say we are talking about a CDS. First, a liquidity horizon is being estimated for this CDS in the trading book, and in case any position is deteriorated, it is replaced by more or less equivalent instrument with the same rating as of the beginning of the period before the deterioration has occurred. Now that will typically reduce my 1 year VAR. Now because of that, there is a possibility that the capital requirement typically is going down. Even that process has been discouraged by FRTB. And finally, FRTB also has highlighted for the credit value adjustment CVAs, even the market risk capital has to be charged for the CVA also, even though it has a counterparty risk that are associated with it. And it did not alter the process. Even in the earlier Basel, it was talking about a standalone capital charge, not integrated with the other market risk. So the CVA's related capital charge has to be computed separately. We have talked about detailed calculation of CVA and the capital charge associated with the CVA in one session, which was entirely using the CVA calculations itself, the chapter on CVA itself. The same thing is being continued. FRTB did not propose any kind of changes associated with the credit charge or capital charge associated with the CVA part. So that is what is this session all about. We have discussed the proposed changes to the Basel market risk capital calculation by FRTB and other important points that FRTB has brought out. How does FRTB plan to classify the positions in the trading book versus the banking book, and other modifications, especially associated with the CVA or associated with jump to default kind of a risk versus the credit spread risk. If you have any further queries regarding this, you can get back to me by giving me a call on the number below, or you can even send in an email at vamsidhar@pagegurus.com. Thanks a lot for listening to this session. Thank you very much.